Hey, welcome back. Following the merger of Livent and Allkem, Arcadium is set to become one of the biggest lithium companies on the planet. They now have operations everywhere but in Africa, and after combining, they became a diversified lithium plus chemicals processing company. You can see on the screen how they kind of complete each other's business model, which can result in synergies, as you are about to see in a bit. What's very interesting is that based on the current projects that have been in development for several years, Arcadium should produce around 250,000 tons per year by 2027. So pretty much tripling the production in 3 years, making them the third biggest player in the market. That by itself can offer a lot of potential even if lithium remains around the current level in the long term, but more on this in the valuation. Before the merger, Allkem, the one that was focusing more on producing among the two, had a production cost of something like 4 to 4,500 per ton, so the margin of safety is very good. Now, the potential of lithium thanks to EV batteries and storage is very impressive, with an expected compound annual growth rate from 10 or 15% to even more than 20% over the following decade, depending on the adoption of electric vehicles. Albemarle has recently cut its 2030 demand outlook due to the slower adoption, but there is still a lot of potential because even if we manage to triple the lithium production from 2019, that would offset like half of the expected demand. Allkem and Toyota had a few projects together, so you can see that there is interest in lithium, especially from car manufacturers. You can see on the screen some recent investments just in that region. It's mostly big mining or car companies, be it alone or indirectly through a common project like Allkem's. This can be both a risk and a positive thing, but I'll go more into detail later in the video because I want to get to the financials. At the current price of lithium, they expect to make around 400 million in EBITDA, which last year came to around 330 million in net income. But if lithium jumps to 25, they could make even $1 billion in EBITDA and potentially over, let's say, 800 million in net income. That would put the current price to earnings ratio at around 15 to 20, which is fair, but in the second case, it would be something like 7, which is unlikely to remain like that. If that happens, given the interest in the company, this could easily double. They also expect a 40% increase in volume this year as a result of a couple of projects ramping up, which is quite a bit. They see capital spending of around $500 million to 750 million this year, but only 100 to 125 million is in maintenance, so they don't need a lot of money to run the business, which is very good. Financially, they are in a very good position, with the 650 million in current assets being enough to cover the current liabilities and the long-term debt, so this is definitely a plus. They see about 60 to 80 million in savings in 2024 following the merger, which is not bad for a market cap of around 6 billion. Now keep in mind that the merger is still very fresh, so the following reports should give a better idea about the new company, the production, cash flows and everything. Due to the falling prices of lithium, they plan to slow down the expansion, and this is a very important aspect of the industry. There is a very good comment from the CEO that I wanted to show you. Following the boom in lithium prices from a couple of years ago, every miner has been investing and increasing production a lot. Now, commodities are all about supply and demand, and right now the supply is growing much more than the demand, which can be seen in the price. We saw issues in China, worries about EVs and so on, while the lithium companies boosted production by 20, 30, 50% or even more. But when the price is half or even 80% less than what it was when we approved the project, it may not be profitable anymore, not to mention that as a result of the crash, many companies may run out of money. Eventually the supply will decrease and we could see a strong recovery in the demand as a result of globally lower interest rates. If you decide to pause the operations in a mine because it's no longer profitable, you can't just make it operational again tomorrow. You have to hire people, sign contracts, utilities and so on, which can be enough time to make the price of lithium jump. Now, the price of lithium may not go back to what it was 2 years ago, but even a 2-3x from the current price can be very good for a company like Arcadium. With lithium, we know that a majority of it is used in batteries, and China accounts for more than half of the demand. With so many Chinese EV companies developing, this share of the demand could be even higher in the future, so whatever happens in the country will affect lithium companies. Another consequence of the battery-related demand is that lithium will always follow the economy, especially the auto industry, which is by far one of the most vulnerable ones to a recession, so keep that in mind. This too can also be good in case we see positive developments in China or the global economy is booming. Now, a very serious risk to keep in mind when it comes to lithium is the chance of it being replaced. Unlike a metal like copper, for example, that's used in a variety of industries, lithium is exposed mostly to a single use case. The idea of lithium-ion batteries is technically over 100 years old, and although it was improved, it has its limits. There is so much research going into batteries that we can know for sure that in a decade or two every car battery will even use it. The risk of replacement is even higher if lithium is expensive, because that would incentivize the use of another technology. And this is why it's so important to find a company that even in such a scenario would survive and be profitable. It's very unlikely to have a full replacement of lithium, so a good company can even thrive in such a scenario in the long term. Another risk I have to mention comes from big mining companies. I said this in the lithium video too, but a company like BHP or Vale or Glencore makes in a single normal year more than the top lithium companies are worth. Lithium projects are limited and very interesting for many companies, as I showed you before. How can you, as a company that makes not even $500 million per year, compete with a company that's making 5, 10 or even more than 20 billion? And the issue is, it's not only one, it's more like 10, 20 or even more depending on what industries you want to look into. The positive thing is that they can also buy a company like Arcadium, and these companies often pay quite a bit. If they manage to triple the production, I think that one of these big companies can easily be willing to pay 20 or 30 billion for Arcadium, making it a 5x from the current price. The valuation is gonna be all about the price of lithium. In a bad scenario, assuming that they break even at around 5,000 per ton, it's very unlikely that they would lose money, even if lithium crashes in half. However, in such a scenario, the market wouldn't care about financials and business quality and stuff, so this could crash by 50, 60, 70% or even more. That, in my opinion, would be an excellent time to buy, but let's see the current price. By the way, this is the advantage of having a low production cost and good financials. In this scenario, other companies would have to stop investing or even sell assets, while Arcadium should be able to keep developing even if they do it at a slower pace. In a second scenario, with lithium at the current price, they would make around 300-400 million per year. If they indeed reach even 200,000 tons per year, this number would basically triple. For a ratio of 15, that's basically the current price, but in just 3 years, this ratio can be only 5 if they triple the production, so there is potential even at the current price. So currently a fair price, but there is potential to, let's say, double naturally in 2, 3, 4 years. I don't have much data about the cash flow of the whole company to do a proper estimation, but considering the high capex, it probably wouldn't be that good for a few years. Anyway, a majority of it is in developing capex, so that's not bad. If they double following the production going up 3 times, they'd reach a similar production and the price of companies like SQM or Albemarle, so from this point of view it makes sense. With lithium at 25,000 per ton, let's say they make 800 million per year. If the market is trading them at only 10 times that amount, that's a market cap of 8 billion, meaning a price of 7.44. That would be a roughly 35% profit, but with a ratio of only 10. If it is 15 instead, this is pretty much a 2x. But with 3 times the production, they would make, let's say 2 billion to be a bit more conservative, so the current ratio is at only 3. If the market is trading them at a ratio of 10, that's a market cap of 20 billion and a price of 18.6, so roughly a 215% profit from the current price. Now, if lithium jumps to the level from 2 years ago, it's hard to estimate the potential because if we look at the 2 biggest companies, they didn't go up that much. But if lithium stabilizes at something like 30,000 per ton and has these ups and downs to like 15 and 50,000, Arcadium can even be a 5x or even more. I think the risk and reward is pretty good at the current price, but I'd like to buy it a bit below the fair value from the second scenario to improve the upside and limit the downside. If I don't manage to, there are other good lithium companies out there, as you can see in this video. Overall, Arcadium is quite a good company to keep in mind and it's already on my watch list. I like both of the companies that became it, especially Allkem, and together they have good financials, nice projects and potential to grow, plus an already well-established production. I think this was a very successful merger and these two companies really complement each other, having the potential of becoming one of the biggest lithium producers on the planet. If the price of lithium eventually gets to even half of what it was 2 years ago, this company has a lot of potential. What's very attractive about them is that given the financials and the low production cost, they have good odds of surviving until and if we see that happen. Can it fall even more? Yes, this is all about the price of lithium, but at the right price, this company should be a good way for me to get exposure to the commodity. I think for me, maybe a combination of Arcadium and maybe a bigger one like SQM and a smaller lithium company like Lithium Argentina should be probably the optimal package for lithium exposure. I get growth from all of them, even if all three are at different stages as a company, potential value and very nice financials, plus a massive dividend from SQM and potentially from the other two as well. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out and make sure to subscribe. Thank you for watching and I'll see you next time.